Welcome back to the Generational Investors Podcast, where we explore the timeless principles of building lasting wealth. I'm your host, John Woodard III, and here we are back again this week with our favorite guest, Mr. John Woodard, founder and president of Woodard & Company. This week, we're getting into our quarterly recap of what we've done as a firm, what's been going on in the markets, as well as a little bit of a forward outlook as well to what the rest of the year has in store for us. I mean, there's been a lot that's happened. And
True.
Yeah, so I mean, just getting started here. We thank you for being back here on the podcast once again, willingly or unwillingly. But just getting started here, as the market showed, things started off with 2026 with a strong momentum. I mean, we reached all-time highs in January, and things kind of continued on into February, but then some breaking news happened, and if you'd like to just dive in.
Operation Epic Fury. A lot of people didn't know how to react or respond to it. The markets, of course, sold off. We sold down about 10% from the highs, and around 6,300 on the S&P, somewhere in that range. Since then, we had a 13, 14-day rally that was the largest that we've had since 1992, I believe it is.
The quickest.
Yeah, the quickest. And so we're down 10%. We're up about 4% today as we do the meeting here. And that's 14% back. So markets, reacted. I recall 1990 when we invaded Iraq. Everybody was worried and very concerned. Iraq had gone into Kuwait and had seized the oil assets of Kuwaitis and so forth. And Bush 1 said, "Hey, we can't let that happen." So a lot of folks were very concerned. They raised cash. They went, had a lot of folks who went to cash. They were just, panicking. But indeed, literally, the minute the invasion started, then the stock market started going up, went straight up from that point on. I guess it's a foregone conclusion that we'd probably win fighting the United States fighting Iraq. In this case, it's a strange kind of a war. But crude oil prices, which surged up, West Texas got up to like $110 a barrel. I recall in 2008, early in the year, I think in March, crude hit $150 a barrel. So this is the highest it's been since 2008. But it was temporary. I think today, as we do the report, we're down West Texas around 90. We were in the 60s just a few months ago. This is not a demand-driven, inflation, too much money chasing too few goods. This is not really a demand-driven oil situation where you have OPEC restricting access and prices going up. This was a kind of a supply disruption. Of course, the U.S. has plenty of oil, and so it's obviously going to affect in China the worst, and then in Europe and so forth. But we have so many tailwinds for our markets. Deregulation. The tax, average taxpayer is going to get $3,500.
Tax refunds from the one beautiful
that's just money flooding into the economy and people spend it. You've got there's earnings. I think it was last week. Consensus of analysts suggested that they think we might see a 19% earnings growth in the S&P.
And That's
for the year. And I should have looked it up. I don't remember that happening very often. I don't know that I remember it happening.
The average is, I believe, like 5 to 7% on a yearly basis.
Yeah, over the last 100 years, 5 to 7%. So you could see it is unreal, and you could see if you look at earnings growth rates, or the earnings per share, if this is 20%. Typically, if you'd seen stocks growing at 20%. You'd have seen them trading at a price to earnings multiple of 30 times earnings. The S&P's price to earnings ratio now is what, about 22, 21?
20 forward, and then it's like 26, 27.
Forward earnings are 20 times earnings. Yes. So arguably, this is 2 to 3 times what historic earnings have been, growth rate. And earnings multiples historically have been around 15 times
15 to
earnings
16,
over the last 100
give or
years.
take.
I mean, you could argue earnings should be. I'm not arguing this. I'm just saying, if you extrapolate that, the market could, if the S&P was trading at 30 to 35 to 40 times earnings, if that was a metric, then the S&P double from here. We'd be at 14,000. I don't think we'll be at 14,000, but you could make the case.
Yes, that's an interesting thing. But yes, and just one clarification going back, you did mention the best streak since 1992, and that was in NASDAQ having a 13-day winning streak, which was the longest since 1992.
Yeah.
So I was wrong on correction on that.
You're right.
But just looking on the first quarter, the S&P was actually down 4.6%, but it's because it ended the quarter. That's because it bottomed on March 30th, and so one day before the end of the quarter, things were down. The Russell was actually up about 0.9%. But looking into it, it seems like it was mainly just the Mag 7, the larger stocks that really took the compression. Microsoft, NVIDIA, Apple, so a lot of them just really compressed down, which made them cheaper from a valuation standpoint towards the end. And that's why they've had quite a rebound going from it. But one of the biggest driving stories was oil throughout for a commodity in Q1. And so for an investor who is not really paying much of a big of attention, and I know we had a segment about this just a few weeks ago, but why does this matter to the portfolio? The fact that WTI hit right after in April, $110 a barrel, worst it's been seen since '08.
And it's still going to work its way through. It's going to work its way through earnings and everything. But in spite of that, look at earnings growth expectations. So as it works its way through, cost of plastics are higher. The cost, so many things, oil. However, it is transitory. It is not a demand-driven situation. It was a temporary supply shock. So I think the market looks ahead. The market looks to the future, and so it's looking past. The markets are looking past it. Well, your earnings are going past it. It's an inconvenience, and it's uncomfortable for a lot of folks who have to go to the gas pump. But it's temporary, and I think should be some long-term benefits.
I heard one analyst's point of view, which I thought was interesting. Tom Lee, the permeable with Fund Strat. Anyways, he was saying that it's almost a better thing that all these conflicts happened in Iran and earnings growth still came out better than it did beforehand, because it's just showing the resilience of the U.S. economy.
True.
That we can have these kind of earnings coming into a conflict like this and then come out even better than before, essentially, at least from an analyst viewpoint. So it's just showing how well positioned we are for going forward.
And I want to point one thing out too, because one of the last podcasts I did was we talked about gold, and gold being a dollar driven. It used to be inflation. It used to be a lot of things, but now it's really kind of dollar driven. And if you look throughout this conflict, Epic Fury, the dollar strengthened. And what did gold do? Gold came down. You could say, well, inflation usually means that the dollar's going to diminish. That's true. But that world events, extraordinary world events that create chaos, cause gold to go up, and that doesn't. It really seems to be linked to the dollar. The dollar seems to be the driver. So if you have large gold positions, or if you have a lot of exposure to the metals, we think the dollar is going to be weak. We think that it helps our exports. There's benefits to a weak dollar, and the administration, I think, would like to have a continuation of a weak dollar for the period. But sound economic policy long term brings a solid dollar and a higher dollar. So right temporarily, I think this year, I think we could see more gold reignite and start to move up again. But because I think this whole Epic Fury, this whole thing with Iran will be winding down here in the coming weeks. It needs to. If Trump wants low oil prices for the election period, you got to get solved. You got to knock it in the head and move on. So,
and talking about other correlating asset classes, I thought it was interesting. Again, I'm just quoting people here, which it looks like I don't have any original thought. But Jim Cramer talked a lot about how the equity markets, a lot of stocks and whatnot. Coming into the conflict, it was all based off what oil was doing. But then as conflicts went around, and we'll talk about interest rates and the Fed and everything in another episode here. But if you started noticing, the 10-year went up and peaked at about 444, I believe, in mid-March. And then it's down to about 427, and it ended the quarter about 427. But if you watch equity markets, really followed that. And so if oil was up one day, stock markets might have been up just because the 10-year was down. And it seemed like that had a heavier correlation. So that's something investors could look out for too. Is just that's something, because bond markets are exponentially bigger than what the equity markets are. It's debt across the countries that are being held all across the world. So that's an interesting point to be looking at.
You sure you don't want to talk about Kevin Warsh for just a minute?
We can briefly touch on it. That's something in coming episodes.
Okay.
That's his hearings are going on right now.
Warsh was an Obama-appointed governor. The man is brilliant, and he wants to put the Federal Reserve on a firm footing now, a different footing. The quantitative easing process that we started in 2009, which was a zero interest rate policy. This is why we saw mortgages go to 2.5%. A lot of folks said, "Well, that was wonderful. I love getting a mortgage at 2.5%." Yeah, but why is that median home now $450,000? It's because mortgage rates went to 2.5%. So there are cause and effects. There are things, and so he wants to work this balance sheet down. He wants to. This was a mistake. There's so many families. What the average age to get into a house now is age 40. First time buyer. And this is because, and everybody, they love those low interest rates. But of course, once again, also if you were a senior citizen living on a fixed income with CDs, mortgage rates went to nothing, like 0.5%. Mm-hmm. So the people that really got taken to the cleaners by that Fed policy and politically driven were senior citizens and now first-time home buyers. And these people are suffering. This is $450,000 for a new home, and Warsh wants to solve some of these problems. I don't know how he could take us back. We need a time machine, but
it seems like he's going to do what he can to shrink the Fed balance sheet and in that position.
Yeah.
And that's something we'll get into that in a whole.
Okay, I just want to make a comment because
of course.
I'm watching this unfold here.
And it's a lot.
Yeah.
So just some of the changes that we made for our clients throughout the quarter and a little bit afterwards. It looks like I can kind of go into it, and you can just help if you'd like to touch.
Well, I would say first, we finished the first quarter about flat. The S&P was down for our stock portfolio. I think we were like up 0.5%, something. Mm-hmm. The S&P was down over 4%, but we've been we're making we're moving. We had some cash that we had raised that we plopped in March. Fortunately, after markets had declined, and so some of the stocks that we bought here, Teradyne and some of those.
Teradyne, SanDisk.
Yeah, SanDisk.
We started off
worked out pretty good.
Very much so. Cisco, PayPal, and Meta. Those were all
they all worked out pretty good.
They've all worked out pretty good. We exited Dell and Oracle.
Yeah,
and
software has been with the advent of AI. A lot of people think this software is going the way of the the dodo bird or something, but it's we'll always need software.
Mm-hmm. It's just how those companies are going to adapt and everything going forward. We added a little bit to small caps to beginning out, and that actually has turned out in favor, as well as shifting away from the more market cap weighted indexes and did a RSP, the equal weight.
Yep.
And that's something that has shown the Mag 7 really took a tank down, and it just was more of a value play, allowing the other 493 stocks in the index to.
Naturally, the stocks that are up 300% this year are more volatile than the ones that are up 12%, or what have you. We've seen a lot of volatility with those, the Mag 7, but they also the best returns.
Yes. So might have to
risk
reward a little bit for things, but just to finish off here, looking forward into the rest of the year here. I mean, it looks like this conflict, it's not coming to an abrupt end, but we're in talks of peace negotiations. We've said another ceasefire extended out. It looks like with the election midterms coming up here in the fall, that's going to cause some things. But is there anything looking forward sector-wise or anything just in the markets to be looking at?
I think the markets in general. I think AI is going to continue to be the play to be. I think they're going to lead the markets. 20% earnings growth, but half of it's coming from what, Micron and Nvidia.
Yeah,
I mean, so
that's actually a statistic that is very interesting that most people don't realize it. Yeah, 2 stocks in the S&P are driving the 19% earnings growth. And that is Nvidia and Micron. And
we have both of those stocks and have had them in our portfolio for several years.
Yes. And so Nvidia is just due to the size of its market cap. I mean, it's having 80% year-over-year earnings growth.
And let me say this: like when you see SanDisk and you see it, we got in the 600s, it went to 900 in a matter of weeks, and you say, "This is ridiculous." It may bring you back mentally to 1999, 2000, but once again, earnings. It's forward is trading at like 10 times forward earnings. Same thing with Micron. They're trading like 20 times. These companies are having like 100%, 150%, extraordinary earnings growth rates, and they're still trading at relatively low multiples. And you had Cisco. Cisco did routers, and Cisco was the best performing stock in the 90s. And I think a $10,000 investment in 92 grew to $15 million by the year 2000. Not bad.
Not too shabby.
But it was trading at like 60 times earnings, 50, 60 times earnings the whole time. And it was because it was exponential. The routers allowed large corporations to have multiple personal computers at various stations, and it connected them all. You could see how that connectivity was just powerful. Well, this AI is powerful too, and that's why we're seeing these stocks. You think it's maybe crazy to buy some of them, but look at their earnings and look at their anticipated earnings. A lot of them are trading at very reasonable multiples.
And I saw also just one thing that gave it such a low forward PE for SanDisk is their EPS growth rate as of yesterday was 155%.
Not bad.
That is, the average company in the S&P is probably maybe 15 to 20%.
Yeah.
I mean, so it's just exponentially, and so it justifies it. And and we can go into a different episode, but it's just a memory shortage that's really coming through with AI, and that's why Western Digital, Seagate, Micron's the leader in it, and then you still have the ones over in South Korea. That's one reason why their markets are doing so good. SK Hynix and Samsung, they're just, anyways. So a lot going on, a lot of good things to be looking forward to. Of course, we can never predict the future, and there's certain things that can occur that no one can really anticipate and cause just a complete market turmoil, such as the conflict in Iran. No one knew that was going to really happen, but
how it's going to be resolved.
Yes, very true. So anyway, so that wraps everything up for this week. Just before we end, we'll go into the pick of the week. My pick this week is on stretching. This is something it's not just for someone who's active, but I think especially if you're active, you need to. Stretching is just stretching your body parts when you wake up in the morning before you go to bed at night. It's recommended 2 to 3 times a week to do it throughout your body, but you show a 30% improvement in flexibility if you just start stretching a few times a week and within the first 4 weeks, just like that.
Yeah.
But it's something.
I feel better already.
It's just something that's good, especially before runs or exercise or whatnot. Gets your muscles warm, but it's something that your body gets tense, especially the more time you have on this earth, and the older you get, your muscles tighten up because typically you're doing less and less exercise.
I'd like to make a comment. So when you're listening to John talk about this, a few weeks back he ran a 51-mile ultra marathon. A couple weeks back he won the Dynamis 5K race. I mean, he's running and exercising. He's doing a lot of stuff. So this is
it's a little bit more pertaining.
Point of interest to him.
Yes, but it's something that everyone, I feel like, can.
I certainly should avail myself.
Yes,
and I did.
And there you go. Yeah. Just day by day. And one last statistic: it has 32% reduction in soft tissue injury rate among athletes who stretch regularly versus those who don't. I mean, that's 32%. Just it makes sense. I mean, if you just start off and start running, I mean, before every sports practice, we always stretch. I've learned that the hard way, though, many times.
Yeah.
But anyway,
me too.
With all that said, we thank you all for listening this week. And also, if you're browsing through Google, you can give us a review on our Woodard & Company website here, if you can. But please, thank you as always for listening. And as always, our motto, always buy quality and diversify. Thank you. The information provided in this podcast is for educational and informational purposes only and does not constitute investment advice, a recommendation to buy or sell securities, or an offer or solicitation of advisory services. It does not take into account your individual financial situation, objectives, or needs. Investments involve risk, including the potential loss of principal, and past performance is no guarantee of future results. Woodard & Company Asset Management Group is a registered investment advisor with the SEC. Please consult your financial advisor or tax professional before making any investment decisions.